What was it in that CPI report that was so unsettling or different than expectations, Meghan? Because there has been a kind of a reaction to that number.
Yeah, I've been a bit surprised at how caught off guard the market actually was to that Friday release. I mean, particularly with Euro area inflation as a precursor to that number. And, I think inflation is surprised to the upside in every major economy. So I think the disturbing part was that it's clearly entrenched and it's not just accelerating, but it's broadening. So I think going into tomorrow's meetings, the more hawkish members of the central bank clearly have the upper hand to try to address that.
Do you think that we're getting making some progress in terms of tightening? Just overall, the stock market is tightening things up a little bit. We know we may go 75 basis points at the Fed. I'm wondering what inning we're in terms of tightening, in your view, because you say the biggest risk from here really is liquidity. Like something could go wrong, I guess. But should we assume we're way behind the curve with rates and they need to be much higher, or are we already in the 6th or 7th inning of the tightening?
No, I mean, I think, it's the first time we've seen this curve inversion since April. The 2-year move, I think, is reasonably straightforward and pegged to policy. The long end flattening that we're seeing is suggestive now of a market that's much more preoccupied with growth risk. And I think, the market feeling and telling us that they expect growth to decelerate meaningfully from here, which is new information for the market. But tightening is fairly broad based as we look at reactions across asset classes. And I think, the market dialogue, not surprisingly, is turning to this as a conversation around, inversion as a leading signal as it relates to recessionary dynamics. But there's always a 12 to 18 month lag thinking about when that might actually take hold if you look at historic norms. So in credit markets, I think the near term implications are much more about where on the curve do you move? Where does cash migrate to try to be responsive to these reactions? And the 10s, 30s flattening is, to me, talking to buy side players in credit yesterday, where the flattest it's been since 2006. I think the immediate reaction was to see net buying of anything 12 years and in, and net selling of anything further out the curve. So it's more of a recalibration, certainly suggestive of tightening across markets.
So, Sam, you would never ignore the bond market. So with all that in mind, what's it tell you about the stock market and what are you doing here?
Well, Joe, as Meghan just mentioned, the stock market is now worried about growth expectations. Certainly, whenever we have been in an inflationary environment where the year-on-year change is 6.5% or higher, that's happened 5 times since the government started capturing inflation data. We ended up slipping into both a bear market and a recession. And typically, bear markets associated with recessions have lasted longer and have fallen further than those not associated with recessions. So the real question is what's going to happen in the second quarter in terms of growth, earnings growth. 70% of the near 150 sub-industries in the S&P are expected to post declines in earnings or reductions relative to the March 31 estimate. So we have an awful lot of groups that are starting to see downward revisions to earnings, and I think that could end up accelerating as the second quarter gets underway.
Do you think this is a cyclical bear and a secular bull, Sam? Or are we in a secular bear?
I think that we're in a cyclical bull within a cyclical bear within a secular bull. My personal forecast is that we end up coming off about 27%. So that would actually be a sub-average bear market. Typically, we find that PE ratios get trimmed by a third. That would bring us down to about a 15 multiple. The real question is against what earnings integer. So my feeling is, maybe 3,500 on the S&P would be a good target for right now.
Okay. This last word, Meghan, you would buy investment grade? You would buy junk? Is there anything? You said that that's what you need to figure out is where to go in duration or quality. What would you do, if anything, or stay in cash?
Yeah, I mean, I think what Barclays strategists are advising, and certainly what we're seeing mirrored in the market, is that 2 camps are emerging. It's if you're total return focused, there are certainly attractive front end hideout opportunities given the recent moves, both in spreads and on the underlying yields. I think you can buy 5-year and in risk with 4.5 coupons now in high quality names. And I think with reasonably limited risk. If you're a yield player, the long end, you can clip 5.25 coupons there, at the other end of the spectrum. And I think rate levels, at levels we've not seen in over a decade. So there are some compelling opportunities at a time where there are meaningful technical underpinnings. Dealer balance sheets are historically light. It's closer to the 1-year lows than the 1-year averages. But the new issue calendar is also underwhelming with a borrower base that's able to be patient here. This isn't a credit crisis. There's liquidity in the system, a scarcity of long-dated supply as borrowing costs erode. But I think importantly, a functional market where there are opportunities across investment grade. But I think staying selective and in the wings of the curve is where those hideout trades exist.
Shepard Smith here. Thanks for watching CNBC on YouTube.